Hi everyone, so let's talk about the commodity volatility index, and in this video I'll explain exactly what it is. Now this is only specifically for futures options and for option sellers specifically, but this is basically the Bible for option sellers, especially if you trade neutrally like I do. It can be extremely helpful. So let's get into it. And first of all, let's talk about my strategy, and I'll be putting it at the beginning of every video from now on. I guess a few people just gonna ask me for that, and I think it's a good refresher. And just so you know exactly why am I making the statements that I'm making, it's all based on my experience and how I trade. So it might be right or wrong for someone else, but it's working for me. So I basically trade like mostly short strangles, and I can definitely sell some calls and some puts. It really depends on what I'm getting. So I'm just looking for a good deal, basically, for a good opportunity and to take advantage of it. It can be in a downtrend and an uptrend, or it can be a sideways movement. Now, generally, I'm looking for 45 days to expiration or less. This is where theta is the biggest. But here and there, I can definitely like go above it and go like up to even 100 days to expiration, maybe even 105, 110 days to expiration. It's just because, sometimes you can really get a really good deal there, and those longer expirations, they are not as affected by volatility. Basically, it's more of a slower paced trading. It can be 30 to 40 days in a position, so it's a bit long, but at the same time, if it depends on the opportunity, right? So I'm just kind of looking to see what the market gives me, and I'm trying to use all the tools at my disposal, which is my strategy and or strangles or calls and puts, and I'm making my trades. Now these are the only products that I trade for futures options. So basically all of these are the most liquid. These are the ones that I have the most experiences in, and these ones are the one that just worked pretty good for me. Now my short strikes are always going to be anywhere between delta 20 and 35. So delta 20 is usually for the short strangles, and for the calls and puts it will be about delta 30, 35, because you just need to collect more premium there to have somewhat of a good stop. My profit target is always 50% of credit, and my loss target is also 50% of credit. So I'm risking one to make one, and my stop loss is dynamic, which means as soon as I'm up about 25% on my position, I will move my stop loss to a 25% loss. And I'll make a specific video about my strategy because I think it's really important. Basically, it's just the mechanics of how I manage, I guess, my position. And I'll always use CVOL for good entry, which is exactly what we are going to talk about today. The Commodity Volatility Index. It's a game changer. It changed my trading forever. I think I discovered it, right after COVID in 2020. So it's been incredible. I trade way less, and I profit way more. Like my win rate just it's over 93%, which is really amazing, obviously. And I barely lose trades because I'm only going for really good opportunities, and I'm patient enough to wait for them to show themselves. So the exit rules is either the targets will hit, so either the profit or the stop loss. I will exit at 21 days to expiration, because if at that point we don't have the full profit, or we didn't exit the position on the targets, then we should probably exit the position. We have a lot of gamma after 21 days, so I don't want to be in a position. Now I can adjust the position if needed. Really, really rare. I usually never adjust the position. I'll just take the loss or the win or whatever it might be. Really rare for me to adjust the position, and I can definitely exit early. So even like before the 21 days to expiration hit, due to certain reasons. There might be a report, maybe the Fed's decision to lower rates or whatever. And again, I'm just looking for a good opportunity, and I want to take advantage of it. Basically, where the risk is worth the reward. So that's my approach. I'm not looking to have a position open all the time. I don't want to sell puts. I don't want to do the 112 or whatever it is. In my opinion, this is just complete ignorance, because there's no such thing as doing the same thing over and over again and just continuously profiting in the market. The market exists to basically the ones that really survive and the ones that really thrive in the market, I believe, are the ones that can recognize a good opportunity and take advantage of it based on using their experience and the tool bag that they have. So, strangles, calls, puts, whatever, managing stop loss. It's all just tools and different ways to manage a position, right? It doesn't really tell you when to enter and when not to. But the commodity volatility index, it will definitely tell you exactly when to enter and when not to enter. Well, at least for me it does, and hopefully after this video it will help you a lot. Same way it helps me. So the CVOL is just the commodity volatility index, the Bible, and it's just a volatility measure of for the CME commodities, and we'll go over them in a second. So it's basically all the commodities that I listed that I'm trading. And you can also think about it as the VIX for futures, for each individual future or commodity more specifically, because it doesn't include the ES or the RTY. Now let's talk about how it actually helps in trading. So based on the CVOL, we can deduct if the price of options is relatively high or low. And because we sell options, we want to sell when CVOL is relatively high to collect more credit, and obviously possibly we can profit from the CVOL going down while in a position. So basically we want to sell our options for as expensive as possible relatively, and once they go down in value due to theta or due to CVOL going down, we can really close them out for some profit. So this is the basic idea, and obviously I don't think it's anything new, but I think it's worth repeating because as basic as it is, this is really the whole premise of selling options, of selling premium. You want to sell really expensive, you want to sell overpriced options. This is exactly the only thing that you want to do. And then obviously you have a way higher chance of profit. So when you sell with a high CVOL, your probability of profit shoots up significantly. From my experience, it shoots up. Specifically based on how I trade, my profit probability should be around, I would say, 70% win rate, 70 maybe 75% win rate, based on how I trade. Because my stop loss is pretty tight; it's 1-to-1. But because I use CVOL and I enter when the options are really overpriced, my 50% or 50% loss on credit is actually give me a really, really wide range for my stop loss, or for my stop loss to get hit. So this is how I use the CVOL, and it brings my probability from about 70 to 75%, which is what I'm supposed to have, to actually about 93%. So I rarely lose trades. It's really tough to lose a trade when you sell overpriced options. Something really crazy has to happen with the commodity for it to kind of keep going crazy on you, and for the options to become more and more expensive after you're already in a position and get to a point where you're down 50% of credit. So basically it has to overcome CVOL and has to overcome the theta, which is obviously really unlikely, and the odds are really in your favor in this case. Another way the CVOL can help us is basically it can help us with seasonality detection. So CVOL can clearly show us if there are specific periods every year where volatility is much higher, and it's pretty clear. And I'll show you an example with corn, and I've made a video about seasonality, and it's super clear there. And CVOL can definitely show you exactly what's going on. Or if we're heading into the winter with natural gas, demand tends to increase or sometimes doesn't, but volatility will definitely tell you, hey, something's going on. The price is more volatile, like way more volatile, like relatively to the summer or relatively to the previous winter, so on and so forth. And you can get so much information from it, and it can, really. If you think about it, you can enter bad positions when CVOL is really high, and you will be extremely profitable, way more profitable than the trader that does not use CVOL to enter the position. It's crazy. You can be really wrong and still profit significantly if you just use CVOL and enter when volatility is relatively high. And for me, I always I always look at CVOL first and then at the graphs. So I don't really care what's going on in the graphs. I will always look at CVOL, and then from there I will kind of make the decision. Okay, it might be a good opportunity. Let's see what's going on in the graph, and then let's see what kind of position we can open up. So CVOL basically tells you if there's a sale in the store. But for us, I guess for option sellers, we need the prices to be higher to benefit. So it's kind of the other way around. But I get the idea. CVOL just tells you, hey, there might be an opportunity here. So let's take a look, and let's actually look at what the CVOL looks like. So it's just the CME website. So you can Google CME CVOL. You'll find the website right away. I'll link it in the description as well, just in case. But basically, it's free. Now the data is delayed by about 15 minutes, or 10 to 15 minutes, I believe. And after I believe 6 p.m., I think it's not displaying any more data. Or after 4 or 5 p.m., it doesn't display any more data, and it will display data starting midnight, basically. So let's take a look. For example, see what is a good example right now. So let's go to soybean meal. You know what? Soybean oil. Soybean oil should be a good example. So when you open up the tab here, so this is how you would basically go and click to see what's going on. So you see a dotted line and you see a smooth line. So the dotted line is just the price of the underlying or soybean oil. So I usually just shut it off, and I usually put it on the 1 year just to kind of see what's going on. Shut it off, and then we can go and see, where is the CVOL currently relative to the past 3 months and then 6 months, and kind of take a look. So if we take a look relatively at the last 3 months, CVOL is right around over here, which is 39.71. The number is right over here, so 39.71, and relatively it's pretty high. So it's definitely in the upper 75% or the upper 70% of the range for the past 3 months. So this would have been the highest point the past 3 months, and currently we are here. So it's a pretty high CVOL, which is exactly what we want. So at this point, for me, it will be definitely no hesitation. I would go and look to see if I can open a position on soybean oil, and I actually have an open position on soybean oil. It's a strangle, and I'll show you exactly what it looks like in a second. But basically, after I look at the 3 months, and I just kind of make sure it's relatively high. So if CVOL would have been, for example, at 38, I would have not want to open a position. I would have probably waited. And if CVOL obviously anywhere underneath it, I would have also not opened it up. So basically, you want it to be on the upper 65-70% of the highest point before. This one is pretty clear. It's relatively high. I mean, it can go higher, obviously. And anything can go always higher. And from my experience, I've learned that waiting for it to be absolutely the highest is definitely not the best thing, because sometimes it means that something really major has happened. And for us, again, we're just looking to get the best possible deal. And from here, we just go on and take a look at the 6 months, and I see, okay, well, relatively to the 6 months, it's really high. Like it's up there. It's up. So this is the lowest point. This is the high. This is the where we are at right now. This is the highest point. Really good. Really good. And you can take a look at the 1 year as well. We are really high. So CVOL is really good. What I really care about is the past 3 months, give or take, and maybe 6 months, depending on the season and on the commodity. But for the most part, 3 months and 6 months is what I look at, and this one looks perfectly fine for me. So from here, for example, I'll just go, and we have this position open. So we just opened the position. Just see, watching this video, what is it? Just a few days ago, basically. I didn't even write down all the numbers for it yet. But basically, our stop losses are at 39.09 or 39.08 and 51.2. So this is a skewed strangle, and it was done on purpose because I wanted essentially to have a range where the price was moving within it for, well, over a year, so since October 2023. And yes, it did exit the range here a little bit, but still overall, this is a massive range. Yes, I opened the position with 105 days to or 102 days to expiration, I believe. But this was the best deal at right now at this moment. So I follow the news closely and see what's going on. You also want to kind of know why the price went up. So the price went up here basically on Friday, so on this day, the monthly USDA report or the WSDE report came out. So it's basically just shows the exports sales for 2024, and I think there's some data for 2025 as well. It just basically gives you an idea of supply and demand for the soybean oil. So what I look for in this report is to see if there's anything fundamental wrong with the supply and demand. So basically, let's say we have 20% of the crop just died due to some kind of parasite, right? So this is really, really serious. So here, the price jumped up and volatility jumped up just based on the exports are being way smaller and sales being way smaller than expected by analysts. That's about it. So nothing fundamentally is wrong with the supply and demand chain or with anything with soybean oil, right? So you also gotta understand the news, and I'll make a separate video and section for the news, because it's also a big thing about trading the commodities, understanding supply and demand. But these are my stop losses. These are not the strikes. As you can see, the price has been moving within this range for quite a while, so over a year. And I made the decision to open this trade. Also, actually, I think when we opened the position, volatility, the CVOL was a bit lower, just a tiny bit lower. I think it was a bit lower, and it went up today. And even though the position currently is about plus 44% actually. So this also tells you a few things about the expiration. It's not as sensitive to volatility change, which is good and bad, but at the same time, I feel like we got a really good sale or a really good deal, I guess, because we used the commodity volatility index. And you can imagine just simply looking at this, people that don't really look at it can enter a position, when they're here or anywhere along that line or anywhere along this line, right? So if you open a position here, the price might not move, but volatility keeps going up. You're screwed basically, right? Because your position is going to get more expensive and you'll be losing on it. Plus the price moves like crazy, right? So this is why you need to be opportunistic when you trade, specifically futures options. And this is how I trade again. So I only speak from my own experience, right? There's probably many other ways to be really good at this, but this is what has worked for me for the past 9 years or 8-9 years. And I've been doing quite well for myself. And so basically, we look for something to happen. Which is I don't look at news first, right? This is what I do all day, or at the end of every day. I just go through every commodity. I see what happened. I see, okay, which one has increased the most? What happened? Is there anything fundamental wrong? Yes or no? So this is basically corn. So this is a good example for seasonality. So for corn, we know we have a seasonality where usually closer to April and May, volatility really increases because of the crop harvesting, and then it goes down around July usually, and keeps going down up until we get to so same over here. Since July, this is 2023. It went all the way up actually since April. And then all the way down, and it just kept going down up until February, March, and then obviously we have the same cycle all around. Now it's not exactly the same as the previous year, but volatility was way higher in 2023. Now 2022 we had this conflict between Russia and Ukraine began, right? This is also something really interesting, and I'll talk about it. So you can see volatility really going up as the conflict essentially unfolds. And then it goes down, and then also went up over here because of some agreements and some disagreements about the exports of wheat and corn. But it just shows you the picture way clearer. So you know if you're getting a good deal or not. And if you're not getting a good deal, you just gonna sit and wait because opportunities will come. They always come. Volatility will always appear in the market, and especially when we have so many products. So this is basically it for the CVOL. Hopefully it makes some sense to you. I know it's not as intuitive to read the graph for CVOL, but you definitely will get used to it. And again, you just look at the, relatively, is it high or low? So here clearly, like relatively, if you look at, let's say 6 months, it's pretty high. It's not the highest, and it will never be the highest, right? So it's all about being relatively high or relatively low. And let's go over every single commodity and just clearly say, is it high or low relatively? So you can see here gold it's a decline, so it's relatively low, right? This is the highest point for the past 3 months. This is the lowest, so you can tell this is the bottom 50%. The past 6 months, even worse. So you can clearly tell this is pretty low volatility. So a good volatility here will be for me probably somewhere around here. Probably I will be somewhere around this range. I will be really comfortable getting into a trade. Given that we have a good trade. Let's go next. Let's look at copper. So for copper, if you look at the 6 months, or the 3 months, it's relatively high. Yeah, it's pretty high. Now, if you look at the 6 months, it's kind of in the middle, right? Kind of in the middle, but some of those spikes are events that happen. So August 5th is the Japanese stock market crash, right? And I don't remember what happened on August 26th or 27th, but like these are outlier moves, right? So you cannot really count them in your like relative volatility kind of calculations, right? So this is why I like to look at the previous 6 months, 3 months mostly. This is pretty high, so I would definitely consider to open a position here, and actually did. And the ranges to the stop loss were not good enough for me, so I decided not to open any position for now. We'll see if CVOL will increase even more. Might open a position, we'll see. But this is a good CVOL. This is a good CVOL, and also another big giveaway that you have a good CVOL is basically you will have a very good range. So because if CVOL is high, you get a lot of credit, means your distance to the stop losses will be extremely wide, right? So here you can see, I was able to get a distance where the price has been moving within this range for over a year, right? So it's a really good sign, right? If you're not sure if the CVOL is high enough or low enough, right? So for copper, let's see, is this copper? Let me actually show you with copper. So with copper, I just did it today. So this is the range for copper with 102 days to expiration, delta 25 strangle. So it's definitely a higher delta. So the delta 20 strangle was about this wide, right? So you can see how it's cutting in multiple spots, and this is not what I'm looking at, right? Or not what I'm looking for. If CVOL is high and everything is good, my range ideally would look something like this, right? For 105 days to expiration, but obviously it's not. And if you go for less days to expiration, I don't remember exactly the range for it, but it was also not as good as what we need, right? So this is something that I look at. Now, if we take a look at crude oil, so crude oil, you can clearly see it's on the really low end. So right, it's really low. There's no point in looking at any positions there. With natural gas, it's the winter, so in winter time you don't touch natural gas, or I don't at least. So 3 months is relatively high, so theoretically you can open a position, but at the same time it's really unpredictable in the winter, so I don't really touch natural gas. It's really volatile and can really it will make more harm than good. Now corn we looked at, but we can look at corn again. It's relatively high, give or take. See here, or sorry, well yeah, I guess it's relatively somewhat high, but the volatility is going down, so you don't expect it to kind of spike up. If it spikes up, something has happened, right? This is also something to note, that sometimes it's just the volatility is just trending down with some spikes, right? So this is why you don't look for volatility to go up all the way here, right? For example, if you're at this point, you might want to take the trade. Because volatility is trending down and it's not flat, it's not going sideways. So it might be a good trade, right? So you would go from that point and look at the graph and make your decision. So wheat, I think we already looked at wheat. For wheat, if we take a look, it's on the edge. I mean, if it would have been a bit higher, it would have been really good, right? You can see at 6 months, yeah. So on the 3 months, if it would have been around here, give or take, I would have considered it like a really, really good CVOL. So just a bit more. If it goes up, we might end up opening a position there. We'll see. And see what we have. So lean hogs. So it's pretty high relatively, and I'll look to see if we can open a position there. We have soybean meal, which is also relatively high, but we already have a position on soybean oil and they are correlated, so I'm not going to open a position on soybean meal. Same with soybeans, but I think volatility is much lower there. So yeah, it's a bit too low for me here. I would like volatility to be closer to the 20th here. We have live cattle, which is also relatively high, which is like the other meats. Feeder cattle don't trade too much, and we have soybean oil, which we already touched upon. And that's about it for the commodities, which is volatility is relatively high. I'm not gonna go through the currencies. It's kind of the same thing. So hopefully this video was helpful and kind of opened your eyes, and hopefully will help you out. Thank you so much for watching, and I hope you'll have a good one. I'll see you in the next one.